Well, let me get across to Taimur Baig, Managing Director and Chief Economist at DBS Bank. Taimur, absolute pleasure speaking with you this morning,
Good
and
morning.
great as always to have you on. Let's start with all things trade wars. And your take on what's happening so far. The last we heard, there is still a deal in the making between India and the United States. But for many countries around the world, they're either waiting for letters or wondering what to do with the letters they've received.
I think this will be the state of affairs as long as Trump is around. I don't think there'll ever be an end game with any country on trade-related matters. Donald Trump has been very transparent in his writings over the last 40 years, even since the mid-'80s, that this is a tool that countries should use as a way to gain market access, use as leverage, because the US market is so big, nobody can live without trading with the US, and therefore they will do whatever the US wants. So this exercise of power does not end with a trade deal, a document, and a set of signatures. It continues on and on and on. We may think today we have a great deal with the US. 3 months from now, Trump will reserve the right to change his mind and lower or increase or anything for that matter. So trade-related uncertainty will weigh in on investment sentiment in particular. Consumption, as you have just alluded to earlier, that it can remain resilient if the overall macro environment is fine. But if I'm going to expand my production footprint in the US or somewhere else in the world with the US in mind, I would be mired in so much uncertainty that I will hesitate. And we're seeing that. I said in Singapore, I'm looking at corporates around me who are very much US focused and have US markets to worry about. They are dealing with day-to-day issues. They don't have the bandwidth to plan for the medium term. So the biggest upshot of all these chronic uncertainty is a paralysis of investment.
Paralysis of investment, yes, Taimur, but I just want to come back to the economic data that we're seeing so far and even the first cut of corporate results in the United States, for example. And it seems like there isn't as much impact as was expected. It's quite contrarian to what you'd expect in the middle of all of this turbulence.
Yeah, wait and see. It's coming. We talked to US corporates, and on the issue of hiring in particular, there is likely bad news down the road. US job numbers are somewhat misleading because you need to sort of break it down into public sector hiring and private sector hiring. And although the first 6 months of this year have been characterized by a lot of noise around DOGE and the various firings that are going on at the federal level, at the state level, there's actually been an increase in hiring that is not sustainable. At the private sector level, the numbers are underwhelming. And my feeling, my call, is that it will be even less underwhelming in the second half of this year. Both trade-related issues and, of course, tech-related disruption is another factor that's going to weigh in. Corporate earnings, as the tariffs become more tangible, not just the pauses, but actual tariffs that has to be paid at the customs level, it will start influencing corporate guidance in the next quarterly report or the reports to come. Corporations will guide some degree of negative impact on their bottom line from the large tariff that they have to pay.
Hi, morning, Alex here. I'm just wondering whether your life as an economist is more difficult now than it has been in past years, particularly because what you saw in the first quarter, inventories have completely changed the calculation for GDP, people pushing product into the US before tariffs come into play. And what you're saying, wait and watch, it sounds a little, or wait and see, it sounds a little ominous. I'm just wondering from the monetary policy standpoint as well, because of the pot shots that are being taken constantly and the desire seemingly from the White House to see a change at the head of the Fed. Does that occur in your opinion? Is that the key risk to monitor? Because tariffs you can't predict.
I also cannot predict Donald Trump's decision-making with respect to Jay Powell. Look, let's just talk about the inventory for 1 second before I come to the Fed decision. Hindsight is 2020. All economists can give you very clean and neat answers to the question, why did the US do well in the first half of the year, when most of us were quite pessimistic within the quarters after reciprocal tariffs were announced that we would see worse numbers. Yeah, so now it makes sense. People advanced a lot of orders, inventories have picked up, that'll be run down in the second half. That would probably lead to weakening of trade and weakening of orders, but for the year of 2025, probably we will not get a very bad number. All the discussion of recession completely out of the window. Now, with that in mind, and with the caveat that Jay Powell may or may not have his job in the coming months and weeks or going into the summer of 2026, what does the Fed do? I think room for rate cut will open up, regardless of the noise between Trump and the Fed. Regardless of who's the Fed chair, who's running the FOMC, there would be ample justification for some rate cuts in the second half of 2025. Growth is not accelerating. In fact, in certain aspects of the economy, you can see some degree of stagnation. Consumption is decent, not spectacularly strong. And on the hiring side, as I said, we will begin to see on the forward-looking indicators some degree of concern from the Fed side with respect to the labor market outlook. If inflation does not surprise substantially on the upside, and we're in the camp that it won't, between energy price and U.S. produced prices, things are actually pretty favorable, imported inflation notwithstanding. And therefore, there would be room to cut rates from where the Fed is now, which is arguably much higher than other G7 economies, and to bring down somewhat. So Fed's decision-making and reaction function, I think, can be looked at in isolation from the drama that is happening between the White House and the Fed chair.
Very interesting. So from that perspective, what we're seeing on the yields and the fact that they are relatively elevated is related to certain other uncertainties, and I'm guessing tariffs also come into play here. What do you anticipate the yields will settle at once some of this dust settles? And I can imagine, as you've pointed out, that that dust is going to be swirling for some time. But then, and what happens, the follow-on to that is what happens to flows on account of those yields?
Right. And Alex, when we talk about yield curve, of course, we will discuss in the context of the US, but there are fascinating things happening with the yield curve around the world, including Japan. Now, on the US, how the yield curve is behaving at the belly versus the outer end itself is very interesting. The market seems to be comfortable buying some things in a not at the 30-year duration, but somewhat earlier. And then, of course, there's question about what happens in the short end with Fed reaction function. The U.S. fiscal dynamics are onerous, no question about it. Trillions of dollars of interest payment, deficit, and all these uncertainty about how much the tax cuts that was passed through the one big beautiful bill would cost versus the offset that'll come from the tariff. All that is clouding the market's view on the Treasury market. And there are some structural issues related to the Treasury market, which the Fed has pointed out in its financial stability survey as recently as November of last year, which is that off the run bond market liquidity in the US is pretty worrisomely low. And therefore, the ability of the market to absorb a large amount of issuance on a sustainable basis is a very big question mark. Add to all of that the uncertainty about what the U.S. Treasury and the Fed would do with an emboldened Trump firing governors here and forcing financial repression there. There is, I think, legitimate concern about the yield environment in the medium term. If these things were not there, we were just going on the merits of the macro, we probably should be seeing a shifting downward of the yield curve in anticipation of slower growth and lower inflation.
Taimur, good morning, Neeraj here. And I want to talk about India with you because I believe recently you said that investors love India but are now getting impatient about GDP growth. But just before we get there, a word on Japan and the yields there, the possibility of higher rates. And the reason I ask this is the worry or the implication of a potential unwinding of a yen carry trade because of what happens to yields and currencies still very, very large in the second half of 2025?
So, Neeraj, as you know, that hedge fund managers, particularly American hedge fund managers, love to trade the yen futures. They love to play with the JGB because, it's a large liquid market outside the US where one can take very large positions. And that can then have outsized impact on local markets. Now, Japan in the last 6 months has seen substantial rise in yield without any disorderly market structure issues. I'm impressed with that. I thought by now we probably would see some accidents here and there, given the very large open positions financial investors have had on the JGB and the yen market. So far, so good as far as the systemic risk is concerned. But if you're looking at it from Japan's perspective, the chronically weak yen, one hand boosts the earning of Japanese exporters. On the other hand, the country is hugely reliant on imported energy and food, and that inflation rate for multiple years now is on the higher side, something that we never considered with the context of Japan for many, many years, if not decades. And that becomes a liability in the political side. So I think that managing that issue itself, somewhat higher than expected inflation, chronically weak yen, is a problem. Add to that the uncertainty around the political process, the steady weakening of LDP's hold on Japanese politics, and all the stuff associated with the trade war. So the Japanese policymakers don't have an easy ride these days. And informing all of this complexity is, of course, the ticking time bomb with respect to the massive 200% of GDP debt burden that they have. So Japan's case, in some ways, is a warning for other countries in the world who have seen their debt GDP ratio rise sharply in the aftermath of the global pandemic. Managing these things can be very, very problematic. Either you get a lot of deflation and zombification of the economy, or you get all these other complexities that I just alluded to.
No, but sorry, so is there a yen carry trade issue upon the world in the second half, Taimur?
Well, I mean, right now, from a cross-currency basis perspective, that attractiveness is no longer there.
Okay.
The way it was there in the, say, the first half of 2024 vis-a-vis the second half of 2025.
Got it. Okay. Taimur, one word on India, can't not talk about it. Now, you, for the last 6-9 months, I think you've been constructive India, and that's, I mean, because you look at equities as well, right? It's kind of paid off, if you will. India's maybe underperformed in the recovery phase, but otherwise done okay. Did you say that somewhere that investors, global investors, are getting a bit impatient with growth not coming back? And if growth does show up, GDP growth that is, you think flow of money, which is kind of been sideways, if you will, comes back into India with a bang?
Correct. So it's kind of interesting. So yes, you're right. You know, we do look at the Indian markets on a cross-asset basis, and the equity market dynamic has been super interesting at a time in 2023 when global investors were selling equities around the world, including India. Indian domestic investors themselves propped up the Indian market in a massive manner. And at that time, you know, I started questioning whether the FII flows are even relevant for India, given the amount of domestic liquidity and domestic excitement we have with respect to the Indian market. On the 2024-25 dynamic, I began to see tremendous amount of dynamism on the private flows side. You talk to lawyers in Bombay and what they're seeing in terms of deal flows, M&As, and FDI, just, you know, extraordinary. But 2025 now is a bit of a sobering moment. Private or public side, we don't see that much excitement, whether it's domestic sentiment or deal flows coming from the outside. So the lawyers that I talk to on the corporate side are not as busy as they used to be. So overall, I think there is a bit of a stock-taking momentum, loss of momentum type dynamic in place as far as India's financial markets are concerned. I would not attribute all of that to impatience about GDP growth. I think some of the deals that I'm talking about and some of the IPOs that I've been seeing, they basically talk about India over the next 10 years. It's not about what happened in the last quarter or where inflation is going or what RBI would do. It is about the medium-term potential. And that, in my view, remains very attractive for global investors, independent of the uncertainties we have with the trade war right now.
Perhaps it's a lull more than anything else.
Yes.
Thanks so much, Taimur, for joining us. Pleasure speaking with you, and look forward to the next chat.
Take care.